What if I told you that the simple act of owning your own home, your own primary residence, can be a more lucrative investment than just about any stock, any crypto play, or really any other investment that you can possibly make, regardless of what your interest rate is or anything else that you think might matter in this scenario? This is exactly the case I'm about to lay out in this video, so stick around and let your mind be blown by some very simple yet powerful insights that you may not have really considered before. If you don't know me, my name is Jake Lyons. I'm a real estate advisor here in the Chicago area with At Properties and Christie's International. And while I'm not licensed in this anymore, I don't claim to have any real licensed authority on this topic anymore. So this is all opinion, not necessarily investment advice. I was a Series 7 licensed financial advisor before I got into real estate. And that is the lens that I look through to evaluate everything for myself, for my clients, and for the world at large. And so from that point of view, I'm just excited to share some of these insights with you and get right into the meat of it. So without further ado, let's start talking about some real stuff here. I'm guessing most of you watching this video have at least at some point probably seen a graph that looks something like this, something that shows in no uncertain terms that people who own a home are financially more well off than people who don't. And at this point, you're probably thinking, duh, of course that's the case. If they were able to afford a home to begin with and have the down payment and afford the payments and have all the financial wellness in general to get into owning a home, then their net worth was probably that high to begin with, or they probably were in a better financial position to begin with. And in some cases, obviously, yes, that's probably true to an extent, but I think that neglects the egg part of this and maybe focuses a little too much on the chicken being the net worth in this case. Is a not a great analogy, but I'm gonna roll with it. So the question that I would want you to consider here is how much of the average homeowner's net worth is because of the simple act that they took that step to owning a home versus whatever they had prior to doing that. Because before they owned that home, they probably looked a lot like the renters here in this graph. To further show that, I don't know how well everybody can see what I'm looking at here. I had to distort the image a little bit, but basically what we're looking at here is a chart of people with different levels of net worth and what percentage of assets is makes up the net worth that they have. So on the top row, you have people with 10,000 net worth, then 100,000, a million, 10 million, 100 million, and then a billion. And then you have liquid assets like cash. The red is primary residence, and then vehicles, retirement, life insurance. So that's probably like whole life insurance and annuities and things like that. Other assets, whatever that might be, mutual funds, stocks, other real estate, and then business interests. So as you might expect, as the net worth increases down to a billion, business interests are obviously going to be the main part of that. Elon Musk isn't a billionaire because he owns a bunch of houses, which he even actually doesn't anymore. But this is about Elon Musk, but he has that because of Tesla and because of whatever. So we or Amazon, whatever the case may be, we understand that. But where the vast majority of us are going to be somewhere between that 10,000 and a million of net worth, you see that the red bar is taking up a huge amount of a person's net worth. So pretty much up until you start getting into that 10 million ranges, that's when other things start taking over more. So the question then is, how is it possible? Why is it possible that so much of a healthy financial person's net worth is tied up in just the equity from the primary residence that they own? And the reason for this are basically it's a combination of these three things. It's the appreciation of the asset that you own. It's the leverage, which is just a fancy word for debt, which is just another word in this case for a mortgage. And then it's the equity that I mentioned just a second ago. So equity being the difference between the value of the property and the amount that you owe on that property. And I'm going to make the case here that leverage is really the key to everything in this scenario. So you might be watching this. I don't know where you're watching this from. Most of the data I'm going to be talking about here is through the lens of the Chicago market because that's just where I am and that's where I happen to have access to good data. The principles that I'm talking about here will apply to anywhere as long as you're buying with proper fundamentals, as long as you're purchasing within an area that you have every reason to believe will continue to be popular and desirable and have at least average to above average appreciation. And you're next to good schools, public transit, highways, whatever it is in your market that people are willing to pay more for and isn't going to change anytime soon. And I have a video that somewhere in this area will link to a video that I've done on basically how to make sure that you are purchasing smart regardless of the market that you're in. So, with that said, here in the Chicago market for the past 10 years, the average appreciation has been 1.8%. That's about average. Anywhere like 1 to 3% is what you would expect if you're in an average market. Obviously, in the last couple of years, things have been a little crazier everywhere. Chicago is a part of that as well. So in this scenario, this is basically just showing you buying a $500,000 house. I'm just going to say house because it's like a catch-all. It could be a condo, it could be a townhouse, it could be co-op, whatever the case may be. But a $500,000 house at the end of 1 year, let's just say you had a completely average year and that it appreciated by 1.8%. Congratulations, you just made a $9,000 appreciation, $9,000 profit essentially. It's not profit because you're not selling, but you get my meaning on a $500,000 purchase. It's not bad. You didn't lose money, at least. Maybe considering taking into consideration what inflation might be, maybe you did lose a little bit of purchasing power, but at least you're not losing money in any kind of real sense like that. Now let's get into a scenario where you only put 5% down. So you got a mortgage, you put 5% down on this property. So instead of putting all $500,000 down, just paying cash for the thing, you only put $25,000 down of your own money. So you only have $25,000 invested into this property. And then same scenario, it goes up by 1.8%. That same $9,000 compared to the $500,000, but now you're not comparing it to the 500,000. Now you're comparing the 9,000 that it went up to the $25,000 that you actually have of your own money into this investment. And so now at the end of 1 year, now it's looking like it's not a 1.8% return. Now it's a 36% return on your money that you actually put in on the asset that you purchased. So is it starting to make sense? Is the power of just a little bit of appreciation and a whole lot of leverage on a relatively safe asset? These are the kinds of returns that are happening for you just on autopilot because you just are paying for the place that you live in anyway. Now let's up the ante even more and factor in the loan pay down, the principal pay down. So we're all probably familiar with if you're watching this video, you're smart. You've probably seen a loan amortization schedule before, so you understand that when you get a long-term loan or like a mortgage or a car payment or anything like that, that there's going to be a schedule of payments and it's going to be front loaded to have to pay off more interest earlier in your loan schedule and then less interest as you go, so that your last payment you're pretty much all principal, no interest, but your first few payments are very highly skewed towards more interest and less principal. So I'm taking into consideration a 9% interest rate, which is higher than it's been. For everybody who's saying, oh, it's not the 2, 3, 4% anymore, and our purchasing power went away and all that kind of stuff. Yes, that does suck. And that is a fact. You can't afford as much house now as you could 2 years ago with the same raw payment being made. And that is a factor. But for what it is actually doing to your financial interest here, it really doesn't impact you all that much for the place that you actually do end up buying. So in the first year, when I ran the numbers here at a 9% interest rate on a $500,000 place that you put 5% down on, your principal pay down is 3245. So now you're adding that to the 9,000 that it appreciated. And so now it's $12,245 that you're making in year one based on the $25,000 that you put down on the property. So now you're looking at a 49% return on your investment in just the first year. And that's just the first year. As the years go on, the same payment is going to pay down more and more principal in relation to the interest that you paid in the first year. And maybe obviously the appreciation is going to vary. Maybe you have a year where it's 5%, goes up 5%, then it's down 3%, then it's down 4%, but then it's going to be jagged. And that's why owning over a long term matters. If you're not going to live in a place for more than 3 to 5 years minimum, it's a lot riskier, especially when you're putting that much leverage down. But assuming that that is the case, it's really hard to beat these kinds of returns. And I will show that in this slide. This crazy looking tapestry here is basically just every asset class ranked each year in terms of the return on investment that you could expect from investing in that asset class as a whole. So if you look at 2023, the best performing asset class was large cap stocks. So those are like the biggest companies you can think of. And then international stocks, small cap, high yield bonds. I always forget what AA means and I always forget to look it up, but whatever AA is, I forget right now. Real estate investment trusts, emerging markets, high grade bonds. So bonds that are regarded as being safe, and then cash. So if you look at just skim along the top column there, you'll see that 49% that you're making just on basically one of the safest and things you can buy. Real estate over given enough time horizon, again, assuming that you're buying in a smart way and that you're using good fundamentals, that you're buying in a good area that is going to continue to have strong fundamentals and be a good area to buy. 49% is going to beat anything, any of these, except for emerging markets in 2009, which was just going crazy at 79%. I don't know what was going on there, but besides that, even if you're not considering the principal buy down, so even this 36% on the appreciation on a 5% down mortgage is still beating pretty much everything on here except for 1 or 2 years. So this is why this right here, what I'm showing you, is why owning your own home is such a powerful tool in the toolbox for building your financial wealth, your financial freedom. There's so many things that you can do with this equity. You can get loans on it, you can sell, you can whatever it is you need to do. And that so this is why home ownership is such a pillar of American life and of American wealth and all these things. So just in case anybody hadn't quite thought of it in this way or seen it broken down in this way. I hope that this was helpful for you. And as mentioned before, there are of course going to be downsides to high leverage, and you don't have to only put 5% down. You don't have to put that much. You can actually put as little as 3% down on a conventional mortgage, depending on the type of property that you're buying. But it's just you don't have to put the 20% down, but you can if you want or if you have it. The more you put down, the less power that the leverage is giving you, but it's also going to be safer, especially if you might be moving sooner than that 3 to 5 a year that timeline that we recommend. And of course, the growth is never linear. It's never all up and to the right. So that 1.8% is just an average. So it might, like I said before, the market might dip. And if there's a time that you have to sell when the market's at a low and you're underwater, then it's good to have backup options if you are comfortable with renting out your home or things like that. Those are things to consider. And then, of course, having it can take longer to build equity since you're at a lower starting point. If you only put the 5% down versus somebody who put 20% down, obviously you have less equity. So it's going to take longer to build that because you're going to maybe have relatively higher interest rates and PMI and things like that with less going towards the principal. These are all things to consider and pros and cons and weigh the different scenarios. And I can get you in touch with a loan officer who can go over the details of all these things a lot better than I can, honestly. But hopefully this is at least illuminating, maybe is something that you hadn't quite considered or seen put in these terms before. And if that's the case, and you want to talk about it a little bit more or explore the Chicago market and you have some questions in that way, you can definitely reach out to me. My name again is Jake Lyons. There's going to be info to get a hold of me all over this video, wherever you're watching it. So that's all that I have for this. And I hope you had a good time watching and got a lot out of it.